Hey, my name is James Nicholson. Welcome to my channel. Now, in this video, we're going to talk about how low could property actually drop in 2023. Now, I've just made a video a couple of days ago about the fact that the market has now started to drop. So in October, Nationwide were reporting a 0.9% drop in house prices. So we're going to talk about that in great detail in this video. But before we carry on with this, can you do me a quick favor? Quickly like this video, guys. Give me a quick like over there and subscribe to the channel and hit the bell notification. Both those things will really help me with the YouTube algorithm. And I want to get more views on these videos to help other people just like you. Well, look, it's been a turbulent few years, hasn't it? At the beginning of 2020, we went into a pandemic. The government had to print a ton of money to get us through that very, very difficult time, to keep businesses trading, to pay the furlough scheme. And all these things have meant that the government has now helped push inflation up. And so in the UK, we have some of the highest inflation in the Western world. We have inflation at around 10%. Now, normally to deal with inflation, the way that you would do that is that you would raise the interest rate to above the actual inflation that you have at the moment. Now, the Bank of England is trying just to bring inflation down slowly. That's their strategy at the moment because they're not looking to crash the economy. They're not looking to put huge unemployment onto the government burden as well. So we had interest rates at almost zero for a while through the pandemic. And now the base rate is sitting at 2.25%. Now, we've had a lot of volatility in the last few months, especially with the mini budget. And after the mini budget, the expectations for where interest rates would go were higher than 6% that the government would have, meaning that you would be looking likely at an 8 to 9, even 10% interest rate. Now, if we had 10% interest rates, the buy-to-let market would completely implode because you're paying often interest-only mortgages. A lot of people were on 1% deals. They suddenly went to 10% deals. Their monthly payment is 10 times higher, which is absolutely insane. So the Bank of England is trying their best to make sure that we get a soft landing, as they say. So what is going to happen with house prices? Well, we've had a 0.9% drop already. That's happened. But there are a lot of companies that are analysing the data. And so I want to talk about a couple of those now and see where they think that the market's going to go. Now, Credit Suisse is a very big bank, and they feel the market is going to drop between 10% to 15%, which is pretty big numbers, right? I've got a multi-million-pound portfolio, so that's a lot of money that will be wiped out off the value of my properties. Now, does that mean that you need to panic? Well, not really if you're not looking to sell. If you're looking to sell a property, then you will obviously have to offer the market price, which is going to be lower. No one's going to pay 15% higher just because you want it. It's got to be worth what someone's willing to pay. Now, as an investor, I always talk about buying and holding, right? So my exit strategy for my properties is death. And so I will keep my properties. They will go to my children. Hopefully, I've instilled into them the value of property and they will send those down to their children in the longer term as well. And so that's my goal with property, is to hold it forever. And so as the market goes up and down, which it has many, many times over the history of property prices, you will get blips like this. You will get rises in interest rates and falls in interest rates and things going up and down. So Credit Suisse, they're saying that the market, they feel, will go down 10 to 15%, right? Which is quite major. Now, Lloyds Bank, who interestingly have said they want to be the UK's largest landlord, so they probably know a thing or two about property. They're saying that they feel that the market next year will go down 8% maximum, like up to 8%. So they're not saying it's definitely going to be 8%. They're saying it's up to 8%. Nationwide have said they feel we'll get a soft landing. They haven't put any real figures out there, but they're saying that they will think that we'll get a soft landing. So I don't know how to interpret a soft landing. Is that 2% to 5%? I don't know. Let me know what you think in the comments. But that's what Nationwide is feeling. Now, what will be happening is as interest rates go up, the economy is more likely to go into a recession. Unemployment is likely to go up, and affordability on mortgages is going to go up, and that will mean there'll be less demand. And that's what really drives a market here, is demand. If you've got demand, as you've seen through the pandemic, people were bidding the prices up, and they were going up and up and up, and there was 2 very big years, more than 15% house prices went up, and that was because people were desperate to get a new property, to move out of the cities, to get that work from home environment. All of these things factored in the market moving very, very quickly for a couple of years. So let's have a look at the last 2 crashes and talk about what happened during those. So the most recent crash is 2008. Oh, 2008. Can't even... 2008. So what do you think the house prices declined in 2008? Well, in 2008, the average price in the UK dropped 15%, which was really high, right? That was really, really, really high. And so that was driven by the financial crisis. Now, the problem that we had then was banks were giving mortgages out like they were sweeties. And you could borrow, people were borrowing as high as 130% of the value of their property. Now, they were quite rare. A fair few people got 110% of the value of their property. They weren't so rare. And common where people were able to borrow 100% of the value of the property. See, the banks knew that house prices always go up. And every 10 years on average, house prices double. So they were banking on the fact that the prices would continue to rise. Now, what did happen was they didn't really check people financially, and they would lend people money that just couldn't afford it. And I've been an investor back then, and I remember going to get a mortgage, and you could literally self-certificate how much you earned. No one checked your bank statements, no one checked your pay slips. You could get a mortgage called a self-cert mortgage and just tell them how much you earn. And I had lots of friends that were builders that got onto the property ladder that wouldn't have been able to if that wasn't a thing, right? And so that meant there was a lot of risk. Some of those people, all you need really is 5% of those people to not pay back their mortgage, and quickly that will spiral into a crisis, which it did. And it meant a lot of banks like Northern Rock and other banks went bust at the time. And so these fundamentals here, we don't have that problem anymore, right? It's very, very rare that you'll get a mortgage over 90%. Now, some of you will say some people have offered 100% mortgages recently. They have, but they're not common, right? They're not very common. And one thing that they are doing, whether you get a 90% or 100% mortgage, is they're checking affordability, right? They're checking and stress testing that you can afford that property when interest rates rise. Whereas before, they didn't care. They would just lend anybody any amount of money. And that's where the problem came in. So legislation came in, meaning affordability checks have been there for a long time. And so that means that the people that have properties now, they're more likely to be able to afford it through a difficult time. Now, I know some of you are going to go in the comments and say, yes, but we've got high inflation, we've got energy crisis and all of this stuff. And that's right. You're very true. But it's still a better scenario than we had in 2008, right? And so that's one thing to consider here. Now, the crash before that was 1989 till 1993. And that was a prolonged crash there. Now, in that period, house prices went down 20% and over 30% in London, right? Which was insane. Now, that could happen again. right? We don't know. Nobody has a crystal ball and can say for sure. I mean, you've got major banks disagreeing. You've got one saying we're going to have a soft landing. Nationwide is one of the biggest lenders in the country. You've got Lloyds, who's another big lender, saying it's going to be 8%. And you've got Credit Suisse, who aren't really a lender for mortgages and stuff, saying it's going to be 10 to 15%. It changes all the time. And it is going to be impacted by how quickly the government can get this inflation under control. So let's talk about positive stuff that might impact this and mean that it's not quite as drastic as potentially a 20% drop that we had in the 1990s. Well, one thing that does look positive at the moment is the fact that we do have some support, maybe not enough, right? But we do have some support on our energy bills, right? We do have some support on our energy bills. Now, that is going to help a certain amount of people, which is very, very good. Currently, we have good levels of unemployment. So you can, if you want to, in some areas, get a job or a second job. There are options out there. There's quite a few vacancies out there. And that also might be something that changes in the near future as well. But one of the things that I've been reading around as well, which potentially could mean this inflation stuff comes down, most of the inflation is driven by the energy market at the moment. The energy is super expensive, and that means that those costs get borne and added onto other stuff, because an office, for example, like my office, this winter it's going to cost more money to heat. So I will need to pass that on to my customers. Now, if you run, for example, I was talking to someone when I was charging my car this morning, and they were saying that they had a restaurant and their energy bill for the quarter went from 3,000 to 15,000, and he's had to put his prices up considerably. So when that starts to come down, that will make a big difference. Now, it is coming down. So the futures markets, last week, gas prices were negative for a period of time, meaning they would pay you to take the gas off them because they had too much and nowhere to store it, right? Now, gas has dropped in price significantly. That's not going to help us this winter because they buy it months ahead. But in the future, that is going to be a positive sign. So hopefully we can bring down this inflation that little bit faster. Now, does this impact you as a property investor? Well, positively, yes. That means that there are going to be more deals out there to have, because some people will just want to get rid of some of the properties they've got. Imagine you're an investor, you own in your personal name, you're paying a higher rate of tax. Now you've got all these additional bills. Maybe you will sell to someone that can run it the right way, the new way, through a limited company. So that could be another opportunity for you guys as well. I looked at an auction this week. Houses that were going for 60 grand 2 months ago went for 40, 45 grand. So that's potentially a big saving as well, because there is less funding in the market. So when you get some funding in place, you can get some great deals in that as well. So I'd love to know your thoughts. Where do you think the market's actually going to go? Comment below. Don't just watch these videos, guys. I want to start getting you guys more engaged in this. Tell me in the comments, do you think it's going to be a nationwide drop of potentially, I don't know, they said soft landing. I'm interpreting that as 2 to 5%, right? Or is it going to be a Lloyds drop of up to 8%? Or is it going to be a Credit Suisse drop of 10 to 15%? I know some of you think it's going to be more, and those comments are valid as well. So keep it kind, but do comment below before you leave. Now, do check out all the other videos on my channel. This is the opportunity of a lifetime. More people make more money in recessions than at any other time in human history. So why not, if you didn't earlier, subscribe, hit the bell. Make sure you check out in the description a link that I've got to invite you to a free live event that I'm running in London. I'd love to meet you and help you get on the property ladder during these times. I'm James Nicholson. Thanks for watching. Check out all the other content on my channel, including this video right here. Bye for now.